Welcome, thanks for watching. I'm Dave Codre with Greenleaf. In this video, we're going to be going through our Opportunity Zone Fund that we launched back in 2019. Overall, we're going to cover things from policy changes that came with the 2020 census, our construction timelines, leasing, and most importantly, occupancy. Since most of you are invested in the fund that are watching this, you know we have 6 properties, 3 residential, 3 commercial in our footprint, which is Tennessee, Georgia, South, and North Carolina. Now, let's get things kicked off. We're going to jump into policy changes first because this is where we actually see the most opportunity going forwards. 3 main factors here. One are the census tracts, the second one is qualifications, and the third is timelines. Census tracts is ultimately the most exciting. The opportunity zones were based on the 2010 census, which included 8,700 plus or minus census tracts. Now, of those census tracts, some were designated as an opportunity zone and some were not. Fast forward to 2020, and when they did the new census, 56% of those census tracts changed. So 56% of something exciting going on. Luckily, the 6 deals that we purchased were in the boring 44% where nothing changed in that tract. But the 56% that did, that's where we can see some opportunity. First thing that happened was some of those tracts got bigger, meaning they took over more space and now possibly there's a larger opportunity zone. Counter to that though, that means other tracts got smaller and potentially lost some opportunity zone space. The third interesting one is some census tracts just went away and got divided into 2, which also became either larger or smaller in the total footprint. So just to keep everyone on their toes, they made some changes. Where we see opportunity is the census tracts that got larger and are in an opportunity zone. Therefore, there could be some properties that are new to the opportunity zone footprint that we could go after, see if they fit our investment criteria, and are a good opportunity for us. We're currently looking through those to see what we can find in our footprint. The last 2 parts are the qualifications. This one's just kind of interesting. If you think about it, majority of your business has to be conducted in the opportunity zone for it to work. If you're a fund like us and you're just buying the real estate, well, of course it's in that footprint and the whole thing is there. If you're a business, well, what do you do if some of your people are working from home and your business is now kind of expanded outside of that territory? Do you still qualify when you're forced to be at home? Not sure how that's going to play out, but it's interesting to follow on the policy side. The last part is the timelines. As we pushed out our due dates for tax returns, not we, but the government, they also pushed out the timeline that was allowable to invest in opportunity zones. And where that could benefit us too is businesses. If they're looking to make investments and get into new office space, or they're looking to move into an opportunity zone, it gives them a little more time to do so. And for people that think kind of the office market might be dead, it's not. We signed 19 leases in our opportunity zone properties in the past 5 quarters. So we're pretty pleased with that, and there are people moving into the opportunity zones. All right, that's it for the policy change. Let's take a look at our construction timeline and see how things are going. One of the most exciting things that we do at Greenleaf are our construction projects. We take some pretty rough properties and turn them into places that people live and work. On average, this takes us about 24 months, which you're going to see in our chart. And now we're going to go into what's changed since the 4th quarter going into the 1st quarter of 2021. So as you see here, the 2 main changes we had were at Heritage Square and North Graham. At Heritage Square, we moved up our lease-up timeline. We were able to get 72% occupied in the 1st quarter, and we're on track to be 90% occupied by the end of May. The team has done an excellent job here showing units during COVID and improving our occupancy. The next one that we had to change for the worse is on North Graham. Our interior build-out is progressing. We're doing very well here, but our outside streetscape is really where we're at a hurdle. We've had the same issue on some other properties as well. Negotiating with the city on how big we had to make sidewalks, setbacks, and parking spaces, that has been a challenge, and it has slowed down our exterior timeline. Overall, we're not saying it's going to extend our full timeline on the project. You can see the end date is still the same, but it is slowing down our renovation segment. Other good stuff, Fairway Apartments, this one is fully operating. The Grove, we are above our 90% occupancy here now, and we are just waiting so we can do our refinance. We're probably about 70 days away from that. The Station Office Park, we are finished here, but we did not have any material gains in the first quarter. Still working on the Lupton. We are aggressively finishing the upper floors here. We have everything framed out from the basement up. We're just going through the roof replacement. We've kind of been talking about that for a while now, and it's been a challenge. We have a big crane out there right now. We're taking sections of the roof off and replacing them, but we still plan to be done this summer so we can start showing and leasing up that building. All right, that sums it up for the construction status on our deals. Now we're going to jump into the residential and commercial sectors, and we're going to go through our occupancy and revenue gains that we saw in Q1. To start off with, we're going to go into residential. In the residential segment, which is comprised of 3 properties, Fairway, Heritage, and The Grove, we had a very good first quarter. We saw our occupancy gains lead to revenue gains, and we actually had our first positive cash flow month in March. We were also positive on a net income standpoint for February and March. This is a huge milestone for stability on these assets, and it also ties directly to the 24-month acquisition to lease-up timeframe that we had discussed. Now we're going to take a look at the occupancy and revenue charts to really give you some data points on how we're doing. In the occupancy side, we continue to see leasing demand and have been able to secure new residents throughout COVID. We finished Q1 ahead of our first quarter plans, which were 85%. We hit 86% in the first quarter. We continue to focus on occupancy quality versus the rental rates, and we see that trend continuing as the CDC restrictions remain in place. Throughout this moratorium, we have about 10% of residents with balances over 2 months of rent, and some that have not paid anything since March of 2020. On the revenue side, let's jump right into the numbers here. Throughout 2020, we saw revenue growth, and that continued into 2021, with the first quarter up 22%. We're over double our Q1 2020 revenue numbers at this point. We have leased well and still collecting during COVID, although not nearly as much as we should have been in the market. Across all our assets, the CDC moratorium has certainly impacted collections, and that impact continues to grow as our substantially late residents continue not to pay. We believe this moratorium, which was extended now through June 30th, and we expect this to go through the end of 2021 as well. Nothing's really been announced, but that's kind of where we see it going. Across the assets, Fairway has had stable occupancy, but definitely issues with COVID-related payments. The Grove in Greenville, we're now 86% occupied at the end of Q1, and we have signed leases and move-ins, putting us at 97%. We consistently gain 20% per quarter here over 3 quarters of leasing. This is a huge success. Heritage, it's gaining traction. We leased 72% in the first quarter, and we're excited to get this asset to over 90% in May and really have some strong revenue numbers going into the second quarter. Overall, on the residential side, we're very happy with Q1. We're ahead of our targets right now. As we go into Q2, our target is $150,000 per month in revenue. We're at $140,000 in March, so we're pretty confident we will be there and surpass that in Q2. What that enables us to do is meet all of our principal payments as we have loans turning to amortization now. It also puts us in good position for our refinances on the Grove and Heritage Square. Now, when we do these refinances, we are very much aware that rates have peaked up in the past month here. They've really doubled from the middle of Q1 until now. But we only have 35 months on our construction loans, so we don't have a lot of time to wait or try and time the market for ups and downs. We still think right now at the 4% rate for a multifamily, that is a very good rate looking out 8 years. So we're happy to take advantage of that right now. We're still not to the point that we can do the refinance, but we're aiming to soon. With those refinance proceeds, with the QOZ tax guidelines, we cannot return that money. That money can't leave the fund or else it becomes taxable. So we're going to look to do one of two things: either reinvest in the current assets we have to drive revenue, or look to find some of these new census tracts. If there's a deal there that makes sense and we can go after that with some of our refinance proceeds, we will look to do that. We'll bring any of those deals up as well before we do anything, but those are the two options that we're looking at. Let's jump over to the commercial side now and see how things are going there. On the commercial side, the occupancy and revenue figures are a little less exciting to talk about since we only have one asset that is online, and that's the station. We're very excited about finishing up our CapEx plans at the Lupton and North Graham. We make things a little bit safer, like removing this giant crane at the Lupton, and we can actually do some showings. Let's take a look at the charts here and see where things are trending. On the occupancy side, we've been steady at 60 to 65,000 square feet. And while we have seen some lease renewals, we also signed 4 new leases. We have had a mix of move-outs, especially in the executive suites. However, that resulted in higher revenue for the quarter with those transitions. We are competitively priced in the market, $14 to $15 a square foot. We will start offering more lease incentives, especially discounted rent, to attract same market movers looking for concessions in this space. The renovations on the remaining 2 properties are wrapping up in Q2. When we get into leasing with those, we do not expect to have any 2021 revenue gains, as most of the potential revenue will be given away in either TI or lease concessions throughout the end of the year. So where do we see this office strategy going? Well, we have an interesting dynamic because we have 2 suburban low-rise centers, and then we have 1 urban core multi-story asset. So we can't really pick one and say, hey, this is the best one versus the other. Now, we have some data points. There's not a lot out there, but we have some stuff on companies that are saying, hey, we're going back to work. One of those is Google. They announced that September they're going to be back in their offices, and they also said, hey, work from home is going to be much less of our platform going forwards. But even within that, what does their back to work strategy look like? How much space are they going to use? And how are they going to do seating? That's still an unknown and something we're all going to be working through and trying to figure out. But if we take it from how does each city look like? That way I think we can kind of get an idea of the market in different cities. On the Chattanooga side, Chattanooga really didn't have any new deliveries in 2020 on the office side, but they did have population growth. They did not lose a lot of employment because of COVID, and they also had gains in the residential rental rates. So they had a 7% gain in rental rates over 2020. We see things like that, and that's positive. You've got people coming to the city, but are they actually working there? That's yet to be determined. But population gain is better than population loss, so we're taking that as a positive. We do like our asset in Chattanooga. It's right in the core area, and there's a lot of bars and restaurants around where it's at. So it's still a fun place to be. There's people moving there, and hopefully that helps us on the leasing momentum front. When we come down a little bit and we go over to Atlanta, that's where our station asset is. It's really in Norcross, which is not Atlanta, but the data talks about Atlanta in general. Norcross is about 20 miles north of downtown Atlanta. Overall, Atlanta is 82% back to work. It is the fastest back to work city in the country. So if anything's positive, that is certainly positive. We're still looking for some large employers here to be back to work, but our asset being kind of on that path from commuting north of the suburbs into the city, maybe people are less excited to do that full commute back, and they want to move their office up to the Norcross area. That's kind of what we're counting on there. We're still optimistic on the low-rise part. We do probably have to lower our rental rates, which I mentioned a little bit before. Then as we go up north and we go into Charlotte, where our other QOZ office is, this market's really dominated by banks. They have a very large urban core market with very high multi-story buildings and a lot of banks. They have been slower back to work. They're able to do a lot more from home or making it work from home. So that market will probably be a little bit slower to recover on going back to work. Our asset, though, is in the northern part of the city, and it's in a more walkable, going out part of town. We think that'll help some as we are going back to work, but to really get some momentum there, we need to see larger Charlotte-based businesses say, hey, we are back in the office. That'll help there. All right, thanks for watching. That wraps up our QOZ update. Hope this was helpful. If there's anything we missed, please let us know. Definitely answer any of the questions you have. Subscribe and watch. We're going to have some live webinars that come out, and we're also going to have some property tours as the Lupton and North Graham finish up their construction. Thanks for watching.